Dividend Growth Investors, bonjour. My name is Mike. Welcome to my channel where I help you invest with more conviction so you can enjoy your retirement. Today I am offering you 3 ideas, 3 plays on the infrastructure business. As you know, both in Canada and in the US, governments want to spend more and more money on infrastructure. One, because a lot of our infrastructure is kind of old, and the second one, it is one of the best way to stimulate the economy. So today we're going to look at 3 companies that I kind of like, and I think they're going to be able to benefit from that wave of investment for the future. So the first one on the list, Brookfield Infrastructure, ticker BIP, BIPC, could be traded on the US market, could be traded on the Canadian market. It pays its dividend in US dollar, but it is a Canadian based company. So then you look at which one is best for your type of account and where you want to put that money in. Why did I select this one as the first pick? Mostly because it is like a ETF of utilities. We have transmission line, we have transportation with rail, toll roads and terminals, we have midstream with pipelines, and then we have data center as well and data transmission. So this business is a little bit of everything. So when you're thinking about long-term spending in infrastructure, you're going to have like a little bit of all of those business segments. What I really like about Brookfield Infrastructure on top of its diversification is how they manage their portfolio of assets. So they have a clear strategy where they acquire high quality assets, they enhance it, and then they do what they call asset recycling, which is selling an asset that you paid at a low price, selling it at a higher price, generating more funds from operation, generating more profit, and then reinvesting that, well, you know where, in more projects. So they're spinning this flywheel all the time. They have been doing that for many years now with great success. And as you can see right there, the target here is to grow the FFO per unit by 10%, providing a strong dividend growth perspective of 5 to 9% and maintaining a decent payout ratio between 60 and 70%. Once again, this is the type of business that will, if you are patient enough, that will generate some returns in terms of stock price, but will also comes with a generous and increasing dividend. For the dividend triangle at Brookfield, as you can see, you must remain patient. The stock price has not been great. The one that you see right now is BIPC. As I said, there's the corporate class share and there's the BIP as well, which is the limited partnership in the US or trust unit in Canada. If you want to avoid all tax nightmare, well, you either pick whatever ticker you want in a retirement tax sheltered account, or you go with the corporate class share. This is why they had created it a few years back. As you can see, the revenue is going up, the dividend is going up, the FFO per share, like going sideways, sometimes increasing. It's a little bit harder on this part, but over a long period of time, Brookfield Infrastructure has been able to increase its FFO per unit at the same time as increasing its distribution. Now, the downside for BIPC, definitely a great complex structure. It's hard to wrap your head around it. There are like multiple companies inside and it is quite opaque. So it's really hard to get the bottom lines of each of those assets. So at one point, there was even last year a short report saying that Brookfield was playing around with FFO per units and their FFO per calculation. On my side, I trust management for their expertise for the long time that they have been successfully doing it. And one thing that you cannot play with is increasing their distribution, because this is really cash getting out of their bank account into yours. Based on that, I think it is a great investment opportunities. Again, not a buy or sell recommendation. You have to do your due diligence, and you certainly have to be very comfortable with a complex structure that is sometimes opaque, and you will not get all the answers you're looking for. So it's not an investment for everyone. Second one on the list, one new addition to my portfolio a few months ago, Stella-Jones, ticker SJ.TO. Why did I take this one? Well, the business model is really nice because it is well diversified, even though it's a company operating in the materials sector. So we have utility poles, we have railway ties, we have industrial products, residential lumber, and logs and lumbers. If it was a residential lumber company, I would be a little bit more hesitant, mostly because then it means that they would be highly dependent on commodity price. And when you have this type of business model, it makes it very hard for the business to become a dividend grower and increase its dividend for more than a decade, which is exactly what Stella-Jones has been able to do so far. They have a lot of growth opportunities in the new spending in infrastructure, mostly at first because railway ties and the demand for utility poles will continue to increase, which is their main market. And at the same time, they have made more than 20 acquisitions in the past few years. So they grow by acquisition on a constant basis. So between the natural organic growth of utility poles and railway ties that will be generated by more transport, expanding new roads, and obviously needing more electric transmission, you will also have the opportunity with Stella-Jones to grow by acquisition, so they're buying smaller companies at the same time. When you look at the dividend triangle, you can see that the revenues, the earnings per share, and the dividends are growing quite steadily right now. It is a low yield, high growth stocks with a lot of growth potential once again. But when you look at the stock price, it does moves a lot. Keep in mind, Stella-Jones has a market cap of around 4 billion. This means that if a major investor decides to sell some shares or buy some shares, the stock price will move accordingly. I know that not too long ago, in the beginning of May, the stock price dropped by I think around 10% on a single day. There was not many news around that. So you just have to be careful about this. This is the type of stock that could move very quickly based on the good news or a bad news. So just make sure that you are well aware of that. And the other thing is, obviously, while their core business is revolving around utility poles and railway ties, there are also other competitors in that area. There's also the use of concrete poles and railway ties instead of using lumber. So that is also another replacement. I actually have to thank some YouTube viewers like you guys that commented when I did my research on Stella-Jones to add that layer of no companies are perfect. So those are definitely some risk that you have to consider on top of the small market capitalization. Last but not the least, when you're thinking about infrastructure, about projects, while you're thinking about equipment, right? So Toromont Industries, one of the largest Caterpillar dealership. As you can see here, the business is mostly about Toromont Cat, so the Caterpillar dealership. They also have Simco that is specialized in refrigerator products, and most of their business evolves around construction, mining, and power system. So Toromont, ticker TIH, is well positioned to benefit from any exploration in the mining, with energy, with construction, all the big place where there's all big spending. They will be there to either sell the equipment or to provide product support. One thing that I really like about Toromont Industries is its longevity. They show a very stable business model. They show 55 years of dividend payments with 34 consecutive years of dividend increase. So they benefit from a lot of organic growth opportunities, and they focus on maintaining a very solid balance sheet. I like those companies that are able to grow, are able to pay a dividend, but are very smart with their capital allocation to ensure that they can continue to survive and thrive depending on where they are. Their latest earnings report showed that there was a slowdown in revenue, a slowdown in earnings, but still they are still very robust. They will continue to increase their dividend, but just to show you that when they hit a wall, they are able to go through it because of that robust balance sheet. Looking at their dividend triangle, you can see right now that the revenue and earnings are stagnating towards the end of 2023. You can see that the stock price has been up most of the 2024. Now it's slowing down a little bit. Of course, the news of not knowing when and by how much interest rate will be cut is affecting TIH and a lot of other companies. This business will continue to grow as spending in infrastructure will come. The downside of Toromont Industries is definitely it's a cyclical business. We may go into a recession at one point, and when this happens, of course, a company like Toromont Industries will see revenue and earnings decline. Likely the stock price will be affected. So when you go into this one, especially right now trading close to the high-time high, you will have to keep a strong focus on the long-term horizon and not necessarily focus on what's going to happen in the next 3 months. If you want to look for more ideas like this, or if you want to shape your own portfolio with a clear strategy, I do have a webinar that is today on Thursday, May 30th. If you miss the webinar, the live presentation that will happen at 1 p.m. You can still register using the same link and watch the replay. It's going to be available later on today. So if you're watching this anytime but on May 30th, click on the link, you'll get the replay right away. In that webinar, I'm showing you how to get rid of that paralysis by analysis. I'm sharing tricks with you so you can have a clear strategy, you know where you're going, and you do not hesitate to invest even in this uncertain market. Because I know it's hard to invest when the market keeps going up, but all the economic data are not necessarily clear. The future of interest rate is not clear. Inflation is still a topic that we talk a lot. So a lot of people will say, I'd rather stay in cash right now and wait. But when you wait, you lose. And most of the time, when you're thinking that you're avoiding a market crash, the only thing that you do is that you're missing on a great investment opportunities. So register in the link below. Watch the webinar today, ask me a live question, or just simply catch the replay and you'll be able to download some freebies at the same time. All right, guys, give me a thumbs up. Tell me in the comments if I forgot any companies that could be a great play in the infrastructure, and we're gonna talk again next Thursday. And until then, don't forget to stay invested.